So today we are working on budgets. Now, budgets are very, very, very structured. And the best way to learn budgeting is actually to walk through a problem. So just to name the budgets, we have the sales budget, which is the easiest one. Then we have the production budget, which tells us how many units we're going to have to produce. Then we have the direct material budget, which tells us how much direct material we have to purchase. Then we move from the direct material budgets to the direct labor budget. How much is labor going to cost us? And then we have other budgets such as variable manufacturing overhead and fixed manufacturing overhead called the manufacturing expense budget. And we also have a selling and admin budget. After that, we do the budgeted income statement. Then we do the budgeted balance sheet. You are going to have to worry about the cash budget. Now, keep in mind that there are lecture videos which walk through a whole budget so you can see me doing that. So keep in mind that is available to you. I don't want you to miss out on those because if you haven't watched them yet, they give you an opportunity to practice one budget so that you can then apply it to other budgets. So let's get started right now. We've got here exercise 9-19. So we've got Peanut Fresh Inc. produces all natural organic peanut butter, which is sold in 340 gram jars. The sales budget for the first 4 months of the year is as follows. Now, I agree that they did the sales budget in this way, but I'm going to show you the sales budget in its normal format, just so that we have the practice of creating a sales budget. Generally, the only thing we get for a sales budget is we get the month, we get the number of units, and then we get the selling price. All right, now that's the information we generally get. So I just want to make sure we walk through this for a second. We start with the name of the company, Peanut Fresh Inc. This is going to be the sales budget. And then we do it for the period for, January to April. And let's say it's 2023. So we start with naming the months. In this case, we have January, and then I'm just going to drag it over. February, March, April. And generally we have a total. So I'm going to put a total here, just so that we've got it. So we start with the sales in units, and then we have the sales price per unit, and that gives us total sales, which is the two just multiplied against each other. Now here, we know it's 48,000, and we know that from this information right here. They give us the sales units. So 48,000, 46,000, 55,000, and 58,000. And this, of course, would simply be added across. There we go. Now, we actually aren't given the sales per unit, so I'm just going to do the total here. And this is 96,600, 121, 125, 200. And then I'm going to add it across. There we go. Now, I can actually work backwards to get this because I can take the total sales and divide it by the number of units, and it will tell me how much I'm selling each jar for. So you can see that my price is not always consistent, right? And so generally we would multiply those against each other, and that would get us the total right here. And that total would be in dollars, of course. I'm going to get rid of the digits. There we go. Okay, so we get a better idea of how to produce the sales budget because I wanted to show you that. So now we're going to move on to the production budget. And it says company policy requires that ending inventories for each month be 20% of the next month's sales. At the beginning of January, the inventory of peanut butter is 14,500 jars. Each jar of peanut butter needs 2 raw materials. Okay, we're going to pause here because they're asking us to do the direct material purchases budget. I want to do the production budget. So start with the production budget. And of course, I'm going to do the same January to April. And I'm actually going to have the same months right here. And here we go. We're going to go across and we're going to have that total. And I'm going to center them. Okay. So now production budget is all in units. So let's be clear about that. The production budget is units. It is never dollars. And so we start with the sales in units because that's our starting point. So I'm going to pull them down. There we go. Now, we have our sales in units, and we have to determine what do we want our desired ending inventory to be. Now, When I'm thinking about this, I want to sell 48,000 units in January. At the end of January, I don't want my shelves to be empty, because if my shelves are empty, I'm not ready for some, let's say, out of budget sales, right? It could be that I'm going to have sales that are a little bit higher. So I want a margin of safety, right? So I'm going to have a desired ending inventory. So even if I sell my whole 48,000, my shelves won't be empty at the end of the month. In addition, I need something on those shelves because I have sales on the 1st of February. And if I've run down my inventory to zero, then I don't have anything to sell on February 1st. So the desired ending inventory is the next thing that I want. And the desired ending inventory is how much do I want on my shelf on the last day of January. And here it says that the ending inventory for each month should be 20% of next month's sales. So they should be 20% of next month's sales. I'm going to multiply it by 0.2. There you go. I'm going to go down here, prepare a production budget for the first quarter. Oh, the first quarter. I'm going to move this over here. Yeah, that's okay. I'm going to move this over here. I'm going to change this total. I don't want the total to be that anymore because it's supposed to be the quarter. A quarter is only 3 months, right? 4 months means that the year is divided into 3. So I'm going to change this to be a quarter, and I'm going to take this and still divide it by that, but I need to change this. I'm going to make this auto sum, and I'm going to add these. There we go. Okay. April is not part of the quarter, of course, so I'm putting it over here. And I'm going to do the same thing right here. I'm going to take April out. There we go. And I should have read this first because it said it's the first quarter of the year. Show the number of jars that should be produced each month as well as for the quarter in total. So I'm doing the total. I'm doing everything that I'm supposed to be doing. I'm going to get rid of this, delete. There we go. Okay, so desired ending inventory is 20% of the next month's sales. So I'm going to do the same thing here. It's 20% of the next month's sales, but in March, it's going to be 20% of April's sales. So that's 29,000. Now, right here, it's got the total for the quarter. So this is actually Q1. When I look at Q1, I'm going from the first day of Q1 to the last day of Q1. And so the first day of Q1 is January 1st. The last day is March 31st. So when I look at the quarter altogether, I want the ending inventory at the very last day of the quarter. And the ending inventory for the very last day of the quarter, I do not add it across. Do not add it across. It is equal to this right here. And I'm just going to double check. Is this, no, I put 50%. Why did I put 50%? 20%, 20%. 20%. That's better. So notice that this is on the last day of the quarter, March 31st. So it's going to be the same number as here. And often what I see students do is they add across. No, that's not the desired ending inventory on the last day of the quarter. That's the total desired inventory added across. It means nothing. All right, so now we've got the desired ending inventory. I then am calculating the total needed. And I add these two amounts together. There we go. Again, we're working in units. And I'm going to add this. Now, let's see. If I add this across, just these three numbers, do I end up with the same amount here? And the answer is no. I'm never going to end up with the same amount here because this is including all these different amounts. So again, I can't add across here. So highlight that. I cannot add across. All right. So now the fact is I've got the sales for the month plus the ending inventory. But you have to think that I had opening inventory. I had a balance at the beginning of the month, the first day of the month. Now, my ending inventory from January becomes my opening inventory for February. My ending inventory from February becomes my opening inventory from March. Okay, so what is my opening inventory for January? Because I don't have that. But you got to think, if we did December over here, Okay, I wouldn't know what this is. This would be question marks, but I know that this would be 20% of January. So I know December is 20% of January. That means the opening inventory is going to be the 20% of January's sales. I could have just taken 20% of January's sales. So I put less beginning inventory. Because you got to think, I have this at the beginning of the month. This is what I want to produce. This is what I want at the end of the month. If I already have something at the beginning of the month, I have to subtract it from what I need because I shouldn't produce that. This will give me my units to produce. So if I add these two together, units to produce. Now, over here, I need the beginning inventory from the period January 1st to March 31st. My beginning inventory from January 1st is going to be this amount right here. Now, let's see. If I add across, do I get the same amount? And I get the exact same amount. So I can't add across here, can't add across there, and I can't add across there. I can only add across for the first and the last one. That's it. It's really important that you recognize how we're doing this. And again, there's lecture videos to show it to you. If you've already watched those lecture videos, then this is the second time you're being exposed to this information, which is awesome. But keep in mind, watching those lecture videos is really important. So now I know how many units I have to produce. Again, I'm just going to put some lines here. This is the number of units that I have to produce. Now, what's next is the direct material purchases budget. So I'm going to start by the company name. And then this is going to be the direct materials purchases budget. And then it's going to be, again, January. And actually, I said January to April, but it's not January to April. It's Q1, quarter one. I'm going to say 2023, which will automatically change the next name too. Okay. Now, to start the direct materials budget, the direct materials budget starts with what am I going to produce? So I'm going to do my usual January, February, March, and the quarter. I'm going to center it. Now what I start with is the units to produce. So I'm going to start with that units. And you can see if you make a mistake in the previous one, it's a cascading error. It's going to be bad. Okay. So this is how many units I'm going to produce. Now I have to say to myself, what materials do I need for this? So it says each jar of peanut butter needs 2 raw materials, 340 grams of peanuts and 1 jar. So I need 2 things. I need jars and I need peanuts. Now, sometimes they show you in the textbook how to do this in one direct material budget. It's got a lot of lines. I don't do that. I just say that this one is the direct material budget for the jars. There, that's my direct material budget for the jars. So for each unit, each jar of peanut butter that I'm producing, how many jars do I need? And I'm going to multiply it by 1 jar. So every single unit needs 1 jar. And it might be silly for me to put the ones in there, but I want to put the ones in there. So now I know the jars for production. Oops, production, learn how to spell. And of course, I'm just multiplying these. And it might be silly to do that, but I'm going to do it anyway, because I'm going to use my usual structure so that we get used to producing the same structure. So this is no longer units. This is now jars. That's the number of jars I need. Okay. Now, I need to know, what do we want my ending raw material inventory to be? Like, I know what I want my finished goods to be, right? Production budget is units of finished goods. But my direct material purchases budget, it's jars to buy. That's what I'm doing here. I'm determining how many jars I have to buy, right? Now, it looks like I have to buy this many jars, but I would have had opening inventory, and I need desired ending inventory. So I'm going to put down what's my desired ending inventory. Company policy requires the ending inventories of raw materials for each month to be 10% of the next month's production needs. Well, this is jars for production. So I need it to be 10% of the next month. So I'm going to multiply it by 0.1. There we go. Now, prepare separate direct material purchases budget for jars and peanuts for the months of January and February. Makes sense that I can't do the month of March because in order to do the month of March, I need the production for April. And they didn't give me the desired ending inventory for April, so I couldn't do my units to produce for April. That means I can't start over here. So they're saying I can't do the quarter, I can't do March. I can only do January and February because that's the only information I have available. So I'm going to leave it right here. I'm only going to do these 2 months, but you can see I'm doing the same thing that I did up here. I've just got a little bit of a change. This is from units to produce, right? And I multiply it by the number of units of raw materials I need. So now that's my desired ending inventory. This is going to be total needed. There we go. And now, of course, what am I going to do? I'm going to do less beginning inventory. And I know if I go over to December, right? I don't know this. I know this is going to be 1. I know what this is. This is going to be 10% of next month's, right? So that's the desired ending inventory, which becomes the opening inventory for the next month. This becomes the opening inventory for the next month. So this isn't units to produce. This is jars to purchase. Purchase. Now, if we knew the cost per jar, so if we could, we would put cost per jar. And let's say the cost per jar is 85 cents. They do not give it in this question, but let's say it's 85 cents per jar. We would then be able to calculate the total amount that I have to pay. So this is direct material costs. If I had this information, I'd be able to calculate it. They don't give it to me here. I'm just demonstrating what it would look like if I did have it. Now, we've done this for jars to buy, but I can actually copy this. I'm going to copy it. I'm going to put it down here. Paste. And now I'm just going to change a few things. There we go. This is going to be not jars to buy anymore. This is going to be peanuts. Right? Now, it's changing everything. So I'm going to do multiplied by 340 grams of peanuts because it tells us that we need 340 grams of peanuts right here. So over here, I'm going to, it's not referencing the right cells, but I just want to use the same format. Okay. There we go. Now, change this to 340 grams, right? This is now going to be peanuts for production. I need this many grams of peanuts and this many grams of peanuts. Then I'm going to do, apologies. I'm just going to paste this down. There we go. I need the desired ending inventory. The desired ending inventory we know is going to be 10% of the, did it say 10%? 10% of the next month. So I'm going to take 10% of this next month. Here we go. I'm going to do March. Just going to pull this over. This is going to be 340. There we go. Now notice it's automatically calculating this, automatically calculating that, automatically calculating this, automatically calculating that. And this is peanuts to purchase. Now, if I had cost per gram of peanuts, and let's say the cost per gram of peanuts is 0.02. There we go. I just want to double check that everything worked out okay. So what I'm showing is that I'm doing the same thing. I just changed some of the titles, but I'm doing the same thing every single time. In this case, peanuts, grams of peanuts. Let's put grams of peanuts for production. And I just want to double check that all of this is working. That's correct. That's correct. That's correct. I'm just going to put that. There we go. Not that it makes a difference. This is 10%. No, it's not. Multiplied by 0.1. Multiplied by 0.1. There we go. This should be adding it together. Adding it together. Adding it together. Deducting that. Deducting that. I want to make sure this is 10%. This is 10% of that. Yep. This is correct. This is correct. There we go. Yep. So notice how familiar this is. Literally, when I am doing the production budget and the direct material budget, I'm doing one thing different. I'm starting off with, well, two. I'm starting off with sales units here for production. Here I do units to produce. So here I take it from this budget. Here I take it from this budget, right? And carry it down here. Here I take it from this budget and carry it down here. I've then got to multiply it by the number of units. In this case, it was 1 jar. Then it was 340 grams of peanuts. So this is telling me the grams of peanuts. This is telling me the number of jars. I still have a desired ending inventory, the total needed, beginning inventory, then the jars to purchase. This is units to produce. This is jars to purchase. And then I just add one thing to it, the cost per jar here or the cost per gram of peanuts right here. Okay. So there's repetition when we're looking at this budgeting process over and over and over again.